See, I understand that there is load of content and information available on technical analysis, and each one of them claims to be the only resource you will ever need as a beginner. And we all know how much truth is in it. And so this video is going to be different. Hello there and welcome to Forex Monopoly. My name is Daksh, and in this video I will show you how to perform technical analysis in a way that saves you time and energy while putting you ahead of the competition. And in this video I will not just mince words, instead I will make everything so clear and precise that you will be able to take actionable steps right immediately. Also, at the end of this video, I will offer a few examples that will help you understand how I conduct my technical analysis. So make sure you watch this video all the way to the end. Now, if you are a complete beginner, I want you to understand what technical analysis is and how it works before we move on the section where I tell you how to perform the technical analysis. Those who have been trading Forex for a while can skip ahead to the steps of technical analysis by using the timestamps. However, I still urge that you watch it because it contains a lot of information that will be useful for you when you do the technical analysis. I want to ask you a question. What motivates you to trade? Now, I realize that's a ridiculous question because everyone trades to make money. So, if you want to make money, you will need something that will assist you with it. Like when you invest in a property, for example, you do so because you believe that price will rise in the coming years, protecting your capital and allowing you to profit from it. And you invest because you believe this area or town will develop and so demand will increase. So here you have a notion that the town is growing and the demand may increase, which aids you in making an investment. In trading, the same is true. Whenever you deal, you must have a cause for doing so. And there are several motives for trading, some of which are fundamental, technical, and sentimental. Fundamental traders look for fundamental causes such as central bank announcements and utilize it to trade, whereas sentimental traders utilize sentiments, that is how many traders are long or short, and the technical traders utilize charts and the past price data. Technical traders don't care about the fundamentals or sentiments and are only interested in how the price acts. Consider the following scenario. You are shopping for vegetables at a grocery store and you take everything you want and realize the price is too high. So you ask for a reduction from the dealer. So how can you recognize if a price is too high or low? How do you figure it out? In the case of vegetable buying, you will base your decision on how much you paid for that particular vegetable the last time you went grocery shopping. And technical analysis is based on the same premise to some extent. Technical analysts are the traders that use technical analysis to evaluate price movement and attempt to forecast and not anticipate price movements for the future trading sessions. Traders use a variety of techniques to analyze this information like candlestick patterns, chart patterns, value zone areas, technical indicators, and so on. And all the technical trader do is look at how the price has moved in the past, how is it moving right now, and how is it or how it might move in the future, and use that information to place trades. You might be wondering how such a thing might function. When I first started doing technical analysis, I had the same question, and here's what makes technical analysis effective. Technical analysis is based on three principles that make it a popular and effective method of analysis. The first one is price move in phases. Price can go in one of the three directions: up, down, or sideways, and this suggests that the price movement could be in an uptrend, a downtrend, sideways, or range. Now the price does not always move in the same direction all the time. It will change stages at several times, and this will happen very frequently. Technical analysis helps traders to identify the price phase in which the market is now in and design tactics to take advantage of that price phase. Using technical analysis methods, you can profit whether the price is rising or falling, or even if it is in a fixed range. The second principle is history repeats itself. If you have ever examined price charts, you have probably seen price patterns and specific locations on the chart where the price behaves differently. This knowledge can be used to gain an advantage, and which is what the technical traders do. But why would you do such a thing? Because history has a proclivity towards repeating itself. If the price has behaved in a specific manner in the past, it is possible that it will behave similarly in the future. And what technical traders do is look at the conditions that existed at the time the price established such patterns, and then seek for the similar developments in the future that could indicate that such a price pattern could emerge again. And this is such a significant advantage that traders take full advantage of it and profit from it. Markets discount everything, which is the third and the final principle of technical analysis. We know that a variety of things can influence price changes, such as the news events, reports, a black swan event, and so on. The basis is that the price of financial assets already takes into account everything that has happened, is occurring, and will happen in the future, and all of these factors are already included in the price by the markets. Thus, the only thing that counts to the traders is the price, which they should utilize to place trades. Now that you know what technical analysis is and how it works, it's time to learn about the many forms of technical analysis. And this will be crucial when I teach you how to do technical analysis. Now, just to tell you, there aren't many kinds of technical analysis used in the market, and I have simply included them to help you understand it in a better way. Also, I'm not going to go into a great length. Instead, I will give you a quick overview of the several forms of technical analysis used by traders. Price action is a sort of technical analysis in which traders don't look at any indicators or other data, instead focusing solely on how the price is acting. Price action analysis is the most basic type of analysis because it only requires a price chart and the ability to recognize and spot price trends. Traders that trade price movement search for chart patterns to obtain an advantage and build a trading bias. The second is using indicators to trade. Traders have access to technical indicators which they utilize to make trading decisions. Now, these indicators are essentially a series of formulas that are used to pass price movements to produce an output that traders can use to construct trading biases. Technical indicators give traders buy and sell indication and inform them when to buy and when to sell. The third is patterns of candlestick or candlestick patterns. The price is represented visually by candlesticks, and candlesticks symbolize everything that the price does. These candlesticks not only provide price information but also assist traders in making trading decisions. Now, certain candlestick patterns have been found to appear consistently over time, and they provide traders with an indication of what the market might do in the coming trading sessions. I will go through the candlesticks in more detail later, and so don't skip on any of the part. And by the way, if you are enjoying this video, make sure you smash that like button. Now that you have learned everything there is to know about technical analysis, I will show you how to put it to use in real world trading. So keep your eyes peeled because I am about to tell you some actionable strategies or steps that you can do right away to get ahead of 90% of traders. Now, there are 4 steps for performing technical analysis, so make sure you pay attention and don't skip on any of the steps. The first thing or the first step is to determine how the market is performing. Like, is the market moving in one direction or the other? That is the market moving up or is the market moving down? Before engaging in any form of trade, a trader must first comprehend market circumstances and what is happening in the market at that particular time. Every technical trader starts by determining if the market is in an uptrend, downtrend, or is it going sideways. Normally, simply looking at the price chart will reveal if the price is trending or trapped in a range, although this can be difficult at times. And so there are other ways to achieve it, and I will discuss the three simplest and the most successful methods of finding the direction of the market. So let's begin with the ways of finding a market that is trending. There are three approaches or ways for finding trending markets. You can use the highs and lows technique, which is the greatest technique or my favorite technique to find the trending markets. You can also use moving averages and trend lines. So let's get started with highs and lows technique. So the first way of finding the direction is the use of highs and lows techniques. Now I've already added lots of videos on highs and lows, like how to draw the highs and lows and how can you use it to improve your technical analysis. So if you are one of those who haven't watched those videos yet, then you can check it out by clicking the I button. I'm also adding the link in the description down below. So now for finding the direction of the market, what you have to do is you have to use highs and lows. And for that, the first thing is you have to understand that when there is a downtrending market, you will find lower low, lower high, lower low and lower highs. A series of lower lows, lower highs, lower lows and lower highs. And if there is an uptrending market, then you will find a series of higher high, higher low, higher high, higher low and higher high. So in an uptrending market, you will always find a series of higher highs and higher lows. So you have to use that over here and you have to try to mark highs and lows. Let us say this was our final lower low and this was our final lower high. So when the price moved above it, we got a new higher high and then a higher low, then again a higher high, higher low, and then again a higher high. So this tells us that the market is uptrending. So this is how you have to use the highs and lows technique to find the direction of the market, and this is going to be the first step of your technical analysis. Trend lines are the next tool for determining the trend, and for those who are unfamiliar with trend lines are the charting tools that are created by drawing a line connecting two or more price points. The market is in an uptrend if the trend line is upward sloping, and it is in a downtrend if the trend line is downward sloping. Now let's move on to the chart where I will explain you this thing in detail. Okay, so the next way is the use of trend lines. So what you have to do is you have to find the direction of the market using trend line. Like if you are not able to use the highs and lows technique, then what you can do is you can use trend lines. So basically there are two different types of trend lines, like the upward sloping one, which tells us about an uptrend, and then a downward sloping one, which tells us about a downtrend. So for drawing a trend line, what you have to do is take trend line tool from here, then connect the lowest wick and then try to connect more than one or two wicks or candles or the price movements in a straight line with the use of trend line. So this tool tells us that the market is uptrending or downtrending. Like in our case now it was uptrending, but as the price broke past this line, now what we can do is we can use this trend line to help us get a sell entry or a reversal entry. So a trend line tool can work both ways, either for continuation entries or reversal entries. So this is how you use trend line to find the direction of the market. The next thing is the moving average indicator. The moving average indicator is used by many traders to establish trends, and you can use any shorter moving average on a smaller time frame and a moving average with a longer time period on larger time frame. Now let us move to the chart where I will show you how to use moving averages to find out trends. Now the other important tool for finding the direction of the market is moving averages. Now it is one of the most used indicator and it is very simple to use. So in the chart I have two different indicators, one of 200 period and the other is of 100 period. That is 200-day moving average and 100-day moving average. So how to find the direction of the market with the use of EMAs or the moving averages? So there is a very simple logic to it. Whenever you see that the price is below the moving average, it tells us that the price is downtrending, that the market is downtrending and the current direction of the market is down. Whenever you see that the price is above the moving average, it tells us that the price is uptrending and the current direction of the market is up. So you can use moving averages to find the direction of the market, and if it suits you, then you can also use this to take entries. Now that you know how to find out what the market is doing, let's go on to the next step. But first, if you enjoyed this video, make sure you press that like button, and I will be adding a swing strategy very soon. So make sure you subscribe to this channel and turn on the notification bell so that you don't miss out on that video. The next step is select a trading strategy with which you are comfortable. After you have determined what kind of market you are in, you will need to decide the form of technical analysis you will use to seek for placing trades. You can use any of the three forms of technical analysis, like price action. As previously stated, price action is a sort of technical analysis in which traders examine historical price activity to predict future price movements. Like trend lines, support and resistance zones, and even chart patterns are used as or by price action traders. Flags, pennants, triangles, rectangles, head and shoulders, double tops and bottoms, triple tops and bottoms, and other chart patterns are highly popular and give a trader a distinct advantage. Price reversals and continuation can be detected using price action tools such as trend lines, support and resistance zones, and chart patterns. For example, you see that the price is rising and draw a bullish trend line. So you get a trend continuation when the price falls back to the trend line and then moves back into the prevailing or the direction of the trend. You can trade appropriately. However, if the price breaks the trend line and subsequently travels in the opposite direction of the trend, you have a price reversal on your hands which you can profit from. The next one is indicator trading. Traders have access to extra tools called as technical indicators which they can utilize to make trading decisions. These are the tools that perform computations for us and provide us with simple trading signals. And these indications are based on pricing data or the price data from the past. There are a lot of indicators available, but that does not mean that you have to try each and every one to see which one works for you. You must first comprehend what each sign first signifies and the difficulties it addresses before deciding onto which one to choose. Now, moving average and the RSI are the finest indicators, and you may use them to construct a variety of methods. So let's first start with moving average. As the name implies, a moving average provides an average of the price over a given period of time. It is a fantastic indicator for trend traders because it allows them to recognize and ride the trends. Traders typically trade moving average crossovers as well as the price bounce or the break of the moving average. When the two moving average, one of a shorter time period and the other of a longer time period, intersect at some point, this is known as the moving average crossover. It is a bullish signal when the shorter moving average crosses the longer moving average to the upside, and it is a bearish signal when it crosses to the downside. When the moving averages function as dynamic support or resistance to the price, it is known as a moving average price bounce. Now, the breaks in the moving average price signal trend reversals. It is a bullish sign when the price is above the moving average, and it is, however, a bearish sign if the price breaks it to the downward side. Now, very soon I'm going to add a video explaining how I trade moving average, and I'm going to go into detail with this video about this topic. So if you don't want to miss out on that video, make sure you subscribe to this channel and turn on the notification bell. Now, after the moving averages, we have the RSI, which is a simple indicator that indicates whether the price is oversold or overbought. And the RSI value fluctuates between 0 and 100, with a reading above 70 indicating overbought and reading below 30 indicating oversold. When the price moves above the level 70, traders sell, and when it moves below 30, traders buy. The RSI indicator is also used by traders to trade divergences, and it is one of the best techniques to use with RSI. Divergence is defined as the deviation between the price and the indicator. In most cases, it is believed that the indicator will duplicate the price changes and what the indicator reading would follow the price. It is like whatever the price will do, the indicator will follow it. However, it is sometimes seen that the price and the indicator have a divergent reading. That is, if the price is making higher high and higher low, the indicator will oppose it and create a lower high and a lower low, which tells traders that something is wrong in the market, giving us a reversal signal. Now, if you want to learn more about divergence, I already have a video for you all, and you can check it out by clicking the I button. Now, don't miss out on the fourth step, because there I will go into actual applications of these indicators which may help you understand it in a better way. The next is candlestick patterns. Candlesticks are graphic depiction of price movement. It depicts how the price changed during that time period. Like open, high, low, and close are the four elements that make up a candlestick, and there are two sorts of candlestick: bullish and bearish. If the candlestick closes above the open, it is bullish, and if the candlestick closes below the open, it is bearish candlesticks. And the wicks of the candlestick depict the price high and lows, indicating how high and low the price has traveled before closing. Although a single candlestick does not provide you with a lot of information, but traders can use its magnitude and different sorts to evaluate the strength. A long candlestick indicates the strength, whereas a short candlestick indicates weakness. A candlestick with few or no wicks represent the strength, whereas a candlestick with long wicks demonstrate weakness. Now, certain candlestick patterns are noted to have formed repeatedly, and they provide valuable insight into the future price movement. Like bullish and bearish engulfing pattern, dojis, and pin bars are some of the most popular candlestick patterns. So now let us do a quick overview of these three common types of candlesticks. The bullish engulfing occurs when the second candlestick is bullish and has a larger range than the first. When the second candlestick is a bearish one with a larger range than the first, this is known as a bearish engulfing candle. Now, dojis are indecisive candles, that is, it indicates indecision in the market, and that suggests neither the bulls nor the bears are in charge. The breaking of either side of the dojis denotes an increase in the strength in that direction. A pin bar candlestick has a small body on one side that is almost non-existent and a longer wick on the other side. Pin bars can be bullish or bearish, and traders can study price behavior, have a bias, and then act on it by taking trades based on places where the pin bars have been created. The third step is entry and exit points. After you have completed the first two steps, namely understanding the markets, developing a bias, and deciding which style of technical analysis to use, you will need to hunt for entry opportunities and find for exits. The entries you make must be in the direction of the current trend and the bias that you have formed. And this is what the trend following strategy is all about. You must also decide where you will leave the trade and where your stop loss will be. In addition to the entries, when I know where to enter, the first thing I do is I mark the price level where my stop loss should be, and then I look for the target price level. And this is something that a very few traders do, but it is critical because as traders we should be more concerned with limiting the risk rather than generating a profit. Your stop loss should be set at a level that entirely invalidates your analysis. And in terms of objectives, you can set them based on the risk to reward ratio, or you can set them particular price level depending on your analysis. It is critical that you write down your entry, exit, and also the stop loss rules. You should have a set of clear and precise guidelines that you must follow at all times without fail. For example, let us say your trading technique is based on moving averages and engulfing candlestick patterns. So if the price is above the moving average, your entry guidelines would be to wait for the price to contact the moving average and then produce a bullish engulfing pattern. Your entry would be right above the upper wick of the engulfing pattern, and your stop loss would be below the lower wick. And if you depart from this plan, it indicates that you lack discipline, which is something you should focus on if you want to succeed in trading. Now, the fourth and the last step is putting it all together. So let's put everything that I have taught you in the above 3 steps and consider some examples. Now let us put everything together. So the first thing which we do is we have to find the direction of the market. So for that, you can either use the trend lines or the moving averages or the highs and lows techniques. And I always prefer using the highs and lows. So I will use the highs and low technique. So from here, you can see the market was moving down. So let this be the high, then a lower high. Then here we are getting a lower low, a lower high, then a lower low, a lower high, then a final lower low. So let this be our final lower low from where the market moved up. So this was the lower high, but when the price moved above it, this was our higher high, then higher low, higher high, higher low, higher high, higher low, and then final higher high. Then again the price moved down, and then it could not create any new higher high. That means the price shifted from bullish to bearish movement, and then the price dropped below this important level. So now the price is in a downtrend. So the next thing is use any strategy which you are using. So, but here is a pro tip: whenever you find the direction of the market, always try to mark some important support and resistance areas, because it plays a huge role while trading. So here, if you can see, the price has rejected this level twice. First over here, then it again retested, then it moved up, and then again it tested it. So when the price goes below this, then we have a longer or a larger downtrend. So if the price gets nearby this area, then we can get in for a possible buy entry. So the next thing is to find whatever trading strategy you want to use. So after you have decided your trading style or the trading strategy which you are going to use, the next thing is to find the entries and exit. So let us say you decided to wait for the price to correct till this point or move till this level, which will be the support, and then you can wait for a divergence or something like that, and then you can go into a buy trade. So till the price reaches till this level, you will have to be patient and just watch the price move till this level. So what your plan will be, what your entry point will be. So the conditions for your entry will be when the price reaches the support area and creates a divergence, only then you will enter a trade. And your stop loss, this will be the most important thing, which is the stop loss. You will have to place the stop loss below this, a few pips below the zone, and then you will have to adjust the take profit somewhere near here. So this is how you have to do the technical analysis. Now let us say if you were to do day trading, then let us take one more example of this. Okay, so here we are on the BTC US dollars chart. Let me get rid of these things. Okay, so let us move to the 15 minutes chart for day trading. So what you have to do is, first you have to again find the direction of the market. So for that, just go to 1 hour time frame and see what the market is trying to do. So we are in a downtrend now because the price is moving down. You can see this was the highest point till which the price moved, which is $64,000, and then we got a lower low, a lower high, a lower low, and the price is now in a range but still in a downtrend. So if we are day trading, the most important area for us will be from this level to this level, which is the recent price movement, because we have to always give much importance to the recent price movements. So go to the 15 minutes chart and see what the price is trying to do if you want to day trade. So here you can see this was the lower low, then a higher high, higher low, higher high, higher low, then again a higher high. Now the price break past this moving average, retested it, and is moving down. So what your game plan should be, if you are using moving averages for taking entries, you will have to wait for the price to move till the moving average, let us say till this level over here, and then keep a stop loss few pips above this, and your take profit should be till this level. This will give you a decent take profit of, let's say, around 1:1, and you can even shorten your stop loss if you are perfect at this strategy. So it will again depend on what strategy you use. So the first step is to find the direction of the market. The second one is to choose what are you trying to do, what are you gonna do, or which strategy you are using, and those strategies should be based on the market conditions. Not, you shouldn't just use any one strategy. If you are doing that, it's okay, but I prefer using strategies based on the market conditions, because if the market is trending, then I go for moving averages. If the market is ranging, then I use support and resistance plus the divergence technique, and so on. So the second step will be to find out which strategy you should use, and the third one is finding out the entry point and the exit points, and exit points contains the stop loss plus the take profit. So this is how you do your technical analysis. I hope you enjoyed this video, and if you did, make sure you hit that like button, and also very soon I'm going to add a swing trading strategy, so make sure you subscribe to this channel so that you don't miss out on that video. Thank you so much for watching.